In this video, I'll be revealing the exact day trading strategy that I use to pull in profit from the market on daily basis, and it's simply a clear step-by-step system that you can start using immediately, and I'll be documenting everything here on YouTube for you so that you can learn, apply, and start seeing real results. So in this video, I'll be covering the breakdown of this proven strategy, the charting tools and resources you need, how to set and execute high probability trades, and finally, the trading tips that will help you skyrocket your win rate. So if that sounds good to you, kindly smash that like button to support this channel, and also subscribe for future trading tips. Also follow me on Twitter and other socials for daily trading insight. Now let's go, guys.
Okay guys, I know you all know about the different strategies we have, from trend line to support and resistance, order blocks, SMC, smart money contracts, and so on and so forth. Well, this strategy that I use is the combination of all these strategies. I put them all together. I kind of shrink them to bring out something unique. Not that I brought out another strategy from it, but I combine them in the sense that I use each one of them on a different time frame. And I have my entry strategy as well as my reverse strategies. So without further ado, let me just go quickly into the chart and see how I use this strategy and how you too can also start using it to make your own profit. So this is Solana. I trade Solana a lot. So from this strategy, the first one, which is our trend line, it simply helps you to know the overall direction of the market. And this is on a weekly time frame. So I'll just bring my trend line to, and I plot it just to touch the weeks. So this is very, very simple. And most of you know how to do this. So this is for trend line. It helps you to plot the overall direction of the market, so that whenever price comes down here, you are expecting it to bounce off. You are expecting this line to be respected, because it's not only you that is seeing this, other traders are also seeing it as well. So this is for trend line. Then on this same weekly time frame, I also plot my support and resistance key levels. Like if you look at what happened here, there was a support here, and the next time market came down, it couldn't break through. Even though it broke through with a wick, but another candle didn't enter above it, it still went below. If you just look at it, it created a double top and then started going down. But for me to see this clearly on Solana, due to the fact that it has not been long that much, so I'll go down to the daily time frame so that I'll see my support and resistance level much clearer. So on this daily time frame now, if you look at this, we had a support here, a resistance here. Price got to this point, rejected, came back again at that same level, rejected it again. The reason is because in trading, there's only two things that are very, very important. Two things that drives the market, and that is what? Demand and supply. Simple. So if you see a price going up from a region or from a level, it means that there's enough demand at that level. And if you see price coming down or being rejected at a particular level, that means that there's a lot of supply at that level. So from what we have here, there was a supply at this level. So that was the reason why the next time market came to this place, due to the fact that something pushed it down here, and everybody is seeing this, all the traders are seeing this. So they are kind of predicting that the next time the market will come here, that the same thing that made it to come down here will also push it down again. And it happened the second time, just like here, came up to this place, got rejected, came back the second time and got rejected again, forming a double top. So the same thing repeated itself here. Then on the third time, it broke it and now served as a support. So initially here, this line was serving as a resistance. It's not the line that is pushing the market down, no. But the line is helping you to map out the area or the level which price reversed from. And the next time price came to that same level, it reacted. It refused to break through because there was a resistance at that place, which now turned to support. And as you can see, it serves as a support here and here, and also slightly here. Then another place this thing happened is somewhere here at this level. If you look at what happened there, market came here, got rejected, came here again, got rejected. Now, as it got rejected here, due to the fact that we have this support line here, this trend line, and every other traders also have this trend line as well on their chart. So once the price comes down to this place, they will all be buying, and that will also push the price up. But for the fact that we also have a resistance here, so once they got to this place, they will also short the market till there was enough demand to break this resistance level, which now later become a support. So that is how support and resistance works. And for people, some people, they do trade it, they will enter their short position on a support level like this, target some little wicks above it, and then target 2 to 3x. It works, but me, this is not my entry strategy. I use this just to know the area of reversals in the market, then I go down further for my entry. So, but you can also use support and resistance as your entry. But for this video, I'll show you what I use as my entry. So going forward, as you can see, price was obeying these key levels. But then, just like I said, only two things move the market, and that is demand and supply. Now, still on this daily time frame, some of us know about the demand and supply strategy, which is order block. Now, for order block to appear, or for it to be valid, it means that there must be a bullish engulfing candle after a red candle. The same goes for supply, demand and supply. For another block to appear on a supply level, then there must be a bearish engulfing candle after a bullish candle, creating what? An imbalance in the market. For example, now this one. So this one happened, and then price started here, which created an imbalance in this chart. So as you can see, all this space, market has to fill it up. The same thing with this. Same thing with this one, market has to fill this space. So whenever price comes down to this region again, it's going to reverse, because many traders believe this to be a demand zone, and the other one to be a supply zone. So many traders believe this to be a demand zone. And if you look at what happened here, the reason why I told you that price broke this line, for most people, they will think that since price has broken, that we are going to go down straight. But no, two things are preventing price from going down straight here. One of them is this resistance line that I've now turned to support, and again, this order block. So we have two confluences here that is pushing the price back up. But as you can see, there's a toggle here. And the reason is because we also have another trend line that is pushing the market down. So the market is kind of in a state of dilemma. Doesn't know if it should go up or go down, because there's a trend line here to push it down, because it has broken the trend line. So it's supposed to go down. But again, on its way going down, there's also a support and a demand level, two confluences that is pushing it up. So it's refusing the market to go down. So now, once I've seen this and I've gotten my demand level on a higher time frame, which is on the daily time frame, I'll now go down to the 4 hours time frame to look for more demand and supply levels that the market is likely to reverse from. So now, if you look at this, we have another one here. We have another one here. As you can see, we have another order block here, which is a demand level. And if you see what happened there, market came to this region and started reacting. But there's a reason why this market broke through. The reason is because there's also another order block here. So market came to mitigate this first one, but then there's another one here. So assuming you enter this market from here and forgot about this one, what will happen is that the market will take you out just to mitigate this one. So for you to be on the safer side, the best thing to do is, if I want to enter this trade, because I use 4 hours time frame as my entry, and also I go down to 15 minutes time frame. That's if I want to do day trading, if I want to enter multiple trades in a day. But if I want to go for more long-lasting trades, I use the 4 hour time frame. But if I want to enter this trade, what I'll do is set my entry here, and then my stop loss below this, or maybe here. Okay, at this week. Then I'll not target 1:2, I'll just target 1:1. The reason is because assuming I placed the entry from here, assuming this is the only order block I had, I'll just place it here and then target 1:2 or 1:3. A quick profit. But because we have two order blocks, if I'm to risk, let's say $10 on this trade, I'll now risk 20 because I'm entering 2. And assuming if I risk $10 on this trade, on 1:2 ratio, it's going to give me $20 profit. But because I'm risking 20, I'll just target 1:1. And that 1:1 will still give me 20 profit. That's a $20 profit. Risking 20, just risking 1 to get 1. So that is what I'll do here. And if you see what happened, it entered, it hit our profit very, very well. So this is for order blocks. So if you see, market came to mitigate, went up, came here, broke this, and went down to mitigate the second one, and still went up again. So assuming you didn't want to enter from here, you just saw two of them, and you're kind of, okay, I'm willing to risk this one. Let me enter from the second one and do it 1:3. Since I'm risking the first one, you will still be in profit. 1:3 will bring you somewhere here. You see, you will still be in profit for risking this one and entering from this level on order block. So what's that showing you? This strategy works for entry. So that is, I use this as my entry, one of my entry strategies. Then I'll show you the second one I use as my entry strategy. Now, if you see what happened, after mitigating this area, market now, due to the fact that the market is on a downtrend, you can also use your trend line also to know the direction of this market. So you can see the market is on a downtrend and it is very, very strong. So no matter the other block that is coming up here to push the market off, this one is more stronger because it has reacted so many times and is stronger. So after mitigating all this other block, this line still put the market further down or on a downside, and then another other block is pushing it up again. So this is one of my entry strategies on 4 hours time frame. Now, if I want to day trade, if I want to enter multiple trades in a day, I go down to 15 minutes time frame. Now let me show you the entry that I use on a 15 minutes time frame. Now I use the SMC strategy. That's a liquidity grab. And this liquidity grab is the same thing. It happens on an order block on a demand level. So for you to get a valid entry strategy on that SMC, you have to plot your demand level. You have to, they call it POI level. And this POI level is the order block, that demand level or supply level. So it must be on that supply level or demand level for your trade to be accurate or for you to have a better win rate. So on this order block now, on this demand level, I go further on 15 minutes time frame to use the smart money concept for entry. And if you look at what happened there, maybe in my other video, I will explain this strategy very well. But from what happened there, market took out this liquidity. Let me zoom in so that you guys will see it better. So from this strategy, we remove this one. From this strategy on another block, market took out this liquidity here. Then at the same time, we had a break of structure here. From this liquidity that took out the existing one, the previous one, it now went up to break this structure and then came down to create another B. That's an inducement level. So he gave us a B. We now have an A here, the first liquidity. And from this strategy, it's saying that for this to be accurate, this first liquidity has to be protected. Since the market has taken out the first liquidity and created a second one, the next time the market is coming down, it is coming down to take out, just like this one took out this one here. The next one that is coming down to take out this one while this one is protected. So you can see, so this second one also created a breakout structure here, another breakout structure. And when the market now came down the second time, it took out this liquidity without touching this one, because this one is now the protected liquidity. So for me now, I'll just place an entry here, put my stop loss slightly below this last week, and then target 1:3 or 1:2. As you can see what happened there, this trade went well and it doesn't stop here. So now, if you remember what I said, this liquidity took out the first one, created a pump that broke structure here. Now that pump created another liquidity, the second liquidity went up again to break structure. Now when the market is now coming down, came down to take out this and leave the first one. Now since this has happened, this one that the market took out now became the first liquidity, just like this one now. It became the first, and this one that took it out now became the protected one. So this one now replaced this one, while this one replaced the first one. So the whole thing is happening again. You see, so we have made our profit on this first pattern the market just displayed here. So we are now moving on to the second one, just like we did on the first one. This one now became the first, and this one now became the last. So I can also say, since this one is the last, it took out the first liquidity. So that means this one is protected. I'm looking for a B. And as you can see, the market created a B here. Okay, let me move this thing. Sorry. Market created a B here before going up to break this structure. So as you can see, it created a B. So for this strategy, market can create a B after taking out the structure, the previous structure. It can create a B, or it can create that B before taking out, before breaking the structure. And that is exactly what happened here. It pumped, came down, created another liquidity, then went up to break this structure. So now this one now became our B. This one is the first one, this one is the last one, and this one is the B. So just like we did on the first one, let me remove this first line so that you don't get confused. So now we now have the first liquidity, the last one, and then the second one. So what are we expecting the market to do now? We are expecting the market to come down, take out this second liquidity without touching this one. So this one is now protected, while this one has to be taken out. Let's see what happened. And it just did that exact thing. So on this trade now, you can also say 1:3 and put it below this liquidity. You just target 1:3. And guess what happened? You're also in profit. So market just took it out, went straight up and hit our profit. Then, so that is for this second. But then again, just like I said, this one now became the first. Okay. So let me know if it happened. Okay, let's say that you've had two now. So this one now became the first. I think there's another liquidity here. Okay, you can use this one as first, or can use this one. Market went up, created a B before going up again. Was there a break of structure? So there wasn't a break of structure, so I wouldn't enter this trade. If you look at these ones, after market created a B, it went up to take out the existing structure. So without this taking out of this, just like the first one, if you look at this one, it took out the liquidity, went up to break structure, created a B, went up again to break another structure. Now this second one didn't follow the same pattern that this one followed, but the thing was still similar. The whole pattern was still similar. What happened there was that it took out the first liquidity, went up, came down, created a B, and now went up again to break this one. So there must be a break of, after a break of liquidity, there must be a break of structure before this strategy is valid. And if you see what happened there, if this one now became our first liquidity, while this one became the protected one, the one that took it out, it has to take out this previous high, because this market, the previous high was what? Here. So the market has to come up and take out this. If it took out this, then I'll know that, okay, this really is protected. So, but it created a B, or let's say it created a B here, but did not take out this. So it went up, it didn't take it out, and because of that, market went down straight. So assuming you entered this trade, you would have been on loss, unless you maybe went down to 5 minutes time frame, because on 5 minutes time frame, I see that if you went down to 5 minutes time frame, you would have been a profit here, because this is your first liquidity, this is the B, and it took out this structure here, and then market later came down. As you can see, it didn't take out this, came down to take it out and then break this structure. But I don't go down to 5 minutes time frame. Get on 5 minutes time frame, you would have been in profit, but I don't go down there. I stop at 15 minutes time frame. So for this trade now, we have what? 2 profit. So this is the breakdown of the strategies I use to make profits on a daily basis. So for day-to-day trading, I use this. Then if I want a trade to last long, I'll just go to the 4 hours time frame, look for one other block at a support region, then long it from there and target 1:2. You get? So the reason why this strategy works best, let me remove all these lines. The reason why this strategy works best is because you might see your other block, you might see another block, but then you fail to draw your trend line. So just like what happened there. Okay, let me bring back this. Okay, just like what happened there. Okay, just like what happened there now. Assuming you are trading only other block, which is very, very advisable to trade one strategy, but at the same time, don't ignore other strategies, because people are also using that strategy to make money in the market. So why should they ignore it? If you ignore it, that means people might be shorting and you will be buying. And the game is, let's say that people that are using this other block are maybe 40% in the market, and people that are using trend line are 60%. Of course, the market is going to go down, because once they see the market retracing here, they will short it. And once they short it, of course, their supply is more than your demand. So it's likely to break this. So what I do, the reason why I combine all these strategies is because using my own strategy, I also like to observe, to keep it in mind that other people use other strategies. So if I'm entering from this region here, knowing the fact that there's a trend line here and people are seeing this trend line, I will not do 1:3 or 1:2. No, I will not. I'll just go down to the lower time frame to take a quick profit that will not touch this, or that will just touch it slightly, because I know that people are likely to short from here. So what am I trying to say? I'm just saying that while trading your strategy, be it support and resistance, be it trend line, be it order block, be it smart money concept, also put it at the back of your mind that other people with other strategies may be opposing your trade. So you also need to be aware of these other strategies, so that once you enter your own, you look for nearest exit. You look for something that will invalidate that your trade. So once you see maybe it's a trend line, once you see it, you now know, okay, since I'm seeing this strategy here and others are doing it, but this is my own chosen strategy, this is my entry strategy, I'll now place my take profit below that place so that people will not short on me. They will not short the market on me. So I don't know if you guys understand what I'm trying to say. Let me know in the comment section if you really understand what I'm trying to say. So guys, this is how I trade the market to make my own profit. So as you can see, Solana is now on a rising wedge. It's going up and down. Touched here, touched here, touched here again. Now broke this place. I'm expecting price to reverse from here. So two things are involved. It's either reverse from here, touch this place, then go down again. I don't know if there's another other block or reversal trend. Okay, there's a support. So guys, this is the breakdown of my previous strategies that I use to make money, and YouTube can do that. If you enjoyed this video, kindly smash that like button. Also subscribe to this channel, and let me hear your thoughts on the comment section on this strategy. Also, let me hear what you are using and how you are observing other traders and strategy, how you are implementing it so that you don't get taken out on your trade. So the next thing is the tools that you need for your trading. Number one is this trading view. The link is in the description below. You can click on it and get registered. Then you also need your Bybit for trading your crypto, your Bybit, Binance, KuCoin, and the rest. All these are in the description below. You can click on it, get registered, and start trading. Then again, I also have my Telegram group which you can join and start making profits. I also drop my trades there on daily basis. So the next one is what I told you guys on how to maximize your profit. So let's say that you use 1:3 on every of your trade, and you have let's say 50% win rate, which means that on every trade you make, you lose 50% and you win 50%. But let's say you enter the market 20 times, you lost 10 trades, and the 10 other trades hit your take profit. So let's do that calculation. And you are risking 1 to make 3. So let's say that this one is $10, and anytime you risk $10, you're making $30 on 20 trades. Remember, you lost 10 and you won 10. So let's do the calculation. So that will be for the 10 trades that you lost. That means, and you're risking just $10 per trade. So that means $10 per trade times your 10 losses. That means you are losing $100. But remember, on each the $10 the 10 other trades that hit your profit, you are targeting what? 3x. So which means you are risking $10 to make $30, and it hits profit 10 times. That's 50% win rate. So on each 10 trades you win, you're making $30 per one. So 30 times 10, that is 300. So what this means is that on 20 trades total for 50% win rate, you lost $100 and you made $300. So that means you are on $200 profit, which is still good. You get? Okay. Now, what if you're up to 50, let's say 40, you have 40% win rate, that means 60 is lost. So on your 20 trades, or let's say on your 100 trades, you lost 60 and you win only 40, but you're still using 1:3 win rate on every single one of them. So let's do the calculation. For 60 trades, using that same $10 per one per risk. So that means 10 times 60, you lost 600. Get? Then 30 times 40, you made what? 1,2. So that 1,2 minus 600 is giving you what? 600 profit. So you see, even on 40% win rate, your loss percentage is far bigger than your win rate, but you're still in profit because you maintained that 1:3 ratio. So this is the best way to go about it. Don't use 1:3 on this trade, and then on this trade you use 1:4, and then on this trade you use 1:1, and then on this trade you use 1:20. No. If you are risking this amount, maintain that same amount throughout your trades. The same thing for 1:2 strategy. So this is how to skyrocket your win rate. So if you enjoyed this video, don't forget to share this video to other traders so that they too can start making money from the markets. So see you guys on my next video. Peace.